All right, what's up, everybody? Excited to be here. Facebook, YouTube, we're live. Super excited to be with you tonight. Tonight is going to be jammed packed full of info. Right now, I will tell you, for everybody that is listening, that just jumped on, that is about to jump on, share this live with a friend, a family member, a coworker, somebody that you know that typically is over the age of maybe 45. They're going to get the most value out of it. You can share it with anyone, but the people that are heading into retirement, thinking about retirement, those are the people that are going to benefit the most tonight. So I'll give you all a minute, share it, send it to somebody that you're thinking about, shoot them the message. If you just hit that thumbs up and hit that like button, it'll also continue to pop up in the algorithm. So do what you can to share this message, guys. For those of you that don't know, my name's Chris. I'm your financial coach, financial planner. I teach people money. And so that's what I came to do tonight, is teach you guys about money. Specifically, we're talking retirement. There's been a lot happening over the past few months in our country, specifically in the stock market, specifically with retirement accounts, with recessions, with inflation. There's a lot of stuff happening, and we need to have some conversations. So like I said, for those of you that are just checking in or just tuning in, make sure that you share this with a friend or somebody that you know that could benefit from the information. There's going to be so much information tonight. Really prepared for you, really wanted to make sure that you got all of the information that you needed in order to get your financial life to where you want it to go, specifically talking retirement, right? So by the end of this, you guys are going to get, so much. But by the end of this, you should actually have an understanding or potentially have a plan of what you need to do in your financial life, of what you need to do with your money, of how to secure it, of what concepts are out there for you to take advantage of. So we're going to go through that tonight. I'm going to share a lot of information with you. This is probably a heavy note-taking time, or come back in and bookmark some of these areas. Give yourself a place to jot down some notes, because this is going to potentially help you get to where you got to go financially. So let's dive in. We got a lot of stuff tonight. I will let you know that at the very end of this, by the end, we're going to host, or we're going to be able to hold a Zoom meeting right after this for anybody that wants to get their questions answered. I'm going to give you so much information tonight. There's going to be so much talked about that you might have some questions that you want to get answered right away. You can drop them in the chat if you want to. I may not be able to get to them right away, but you can feel free to drop something in the chat. If not, stick around for our live Q&A session. We're holding it on Zoom. We'll be able to get you a link. I'll probably flash a link up a little bit later on in the show, or a little bit later in the webinar, so you have it. But again, that's just for people that want to be able to dive in and get a little bit more one-on-one and get their questions answered. But tonight, let's give you all the information that you need. I'm going to dive in, and let's take a look at retirement. So here's a question, ladies and gentlemen. Are we in a retirement crisis? Are we in a retirement crisis? I believe we might be, right? But you might not believe so. But if you do believe that we are, then obviously there are going to be some things that we need to do when it comes to preparing for what's up ahead. Here's the basis. Let's give a little education. For those of you that know or maybe don't know, I'm big on financial literacy, financial education, really understanding the basics of money and what we need to do to prepare our families properly. So in retirement, understanding that this is how they taught us to retire. This is how they taught us, meaning the United States, baby boomers up until now, kind of this idea of a three-legged stool. This idea of a three-legged stool basically means that you're going to have in retirement, your Social Security, your pension, and your personal savings. Those are the three things that you're going to have in order to retire. So we're going to break down each of those legs, because right now, and again, I want to preface 45s and older, right? If you're a little bit younger, if you're logging on, you're in your 20s, you're in your 30s, it's going to be great information for you, I promise. But it might not all be pertinent to you, because at different ages, different stages, different levels, money is different. So specifically 45 and older right now, thinking about that retirement side of things. Retirement normally was Social Security, pension, personal savings. Well, let's break each of these down. Look at Social Security. Did you know that Social Security alleged may run out of cash? Allegedly, it may run out of cash. Here's from the Social Security Administration website. It says, as a result of the changes to Social Security enacted in 1983, benefits are now expected to be payable in full on a timely basis until 2037, when the trust fund reserves are projected to become exhausted. That's right. 2037, the trust fund reserves are projected to become exhausted. That means there's no more money for Social Security. That's a projected number. It says at the point where the reserves are used up, continuing taxes are still expected to be enough to pay at least up to 76% of the scheduled benefits. But obviously these numbers could change. So if you're a person that's listening to me right now and you're thinking about when you're going to retire or thinking about retiring, then you got to understand one thing, that Social Security may not be around for all of us. It may not be. Not saying that it won't be, just saying that it may not be. So you got to pay attention to that. Second thing to know, pensions. Pensions. That is a way that we were taught that we were going to retire. So here's an article from USA Today. It says, it's really over. Corporate pensions head for extinction as the nature of retirement plans change. Here it says the percentage of workers in the private sector whose only retirement account is a defined benefit plan is now 4%, down from 60% in the early 80s. So for those of you that don't know what a pension is, a pension was at a time, and some people still do have pensions. We'll touch on it. But for most people, we don't have those pensions. But if you do, just understand that all that meant was that you gave your service and your time to an employer. And because of that, they were going to guarantee that they paid you in retirement. My grandmother gets a pension, right? She graduated. She retired. It's kind of the same thing. She retired, and then they promised her this kind of stream of income for life for her service due, or for the service that she worked. So now understand that only 4% of people actually have a defined pension plan, down from 60%. It says the number of pension plans offering defined benefits, which basically just means that the payout is guaranteed, it plummeted from about 73% 1986 to 2016. So the amount of people that had pensions, defined benefit pensions, plummeted 73% over 30 years. Okay? So understand, pensions may not be around for us. They may not be around. If you are lucky enough to have a pension, here could be a possible explanation as to why, because traditional pensions are still offered by about 84% of government and local and state and local governments. So you working for the state, you're working for that county, whatever the case is, you might get a pension. That's quite possible. But there's a real reason why 73% dropped over the past 30 years and only 4% have it now, and the government is actually holding on to it. There's a reason that says potentially politicians, for them to get elected or reelected, they can't try to take away someone's pension. Imagine a politician, imagine someone running for an elected official, and they're running on some type of campaign that says, in order to cut the budget, we got to take away people's pensions. You're never going to win, right? No politician would ever win if they said that. But yet, if you pay attention, our country is $28 trillion in debt as a country. And the states are just the aggregate of the country, right? They're just made up of the country is just made up of the states. So that said, it says, given budget challenges in many states, many public sector pension plans do not have enough money set aside to cover all the future payouts promised to current workers. So the pension that they potentially are promising you, guess what? May not even be there. May not even be there. I know this might be hard to think about or hard to hear or something where it's like, man, I really don't know if that's the case. But just understand where we are as a country economically. There's lots of things that could happen over these next 10, 15 years that maybe we've never seen in our lifetime. And when your government, when your federal government is 28 trillion in debt, and each state has some form of debt as well, you can't logically believe that this money to pay for all of these people's retirement is actually going to be there. So we got to think of another way potentially, but just understand pensions are still a thing. Not many people have them, but some do. Personal savings is the last one. America's premier retirement vehicle is a 401k, 403b, IRA, something along those lines. This is an older article that was published that said, hey, the inventor of the 401k says he created a monster. It says, but like many critics, this is an excerpt from the article. It says, but like many critics in recent years, he began to think 401ks might not be the right thing. He created a monster that should be blown up. Why did he start talking about that? Why did they say that? Well, we got to understand where the origin of these 401k come from. When we went from pensions to actual personal savings to what is going to be the liability on the employee. When that started to happen, that's when we made that shift. But understand that the 401k was really only designed, because it's a tax code, the 401k, right? Tax code was only really designed to limit the use of executive cash deferred plans. So the cash deferred plan was something that companies used to use in order to reward their higher paid executives, right? Or the people that they're giving bonuses to. But this 401k kind of came into play, and what it started doing was replacing the pensions. But we didn't know this had to be our premier retirement vehicle. Why? Because we were supposed to have other ways to be able to retire. Social Security, pensions, other things. But now we're stuck with just one vehicle. Most people, and many of you that are listening, might only have your 401k, or you might only have your 403b or 457 or TSP. That might be the only thing you have for retirement. Well, now, if you're not going to get Social Security, and many of us will, right? Just might not be able to get the full amount, and you don't have a pension, then you're really banking on your personal savings. That's it. And inside of these policies, inside of some of these 401ks, I'll tell you, you have to really dive in and get educated. The reason why we're talking about this tonight, ladies and gentlemen, is because this is time for you to get educated on your retirement. If this is something that's important to you, which, you know, retirement's not important to everyone, but for those of you that it is important for, you have to start to understand that you got to get a good grip of your money. You got to learn about your money. So it says here also in this article, it said the plans had grown so overcomplicated and fraught with hidden fees, opportunities for bad decisions, that they were better at enriching the financial industry than the actual saver. That is a clip out of this Time magazine article, I believe, that says in 2005, it said the Great Retirement Ripoff. It said millions of Americans who think they will retire with benefits are in for a nasty surprise. That talked about the 401k. Also, again, in 2009 on Time magazine, it talked about why it's time to retire the 401k. So just understand, if you are in one of these vehicles, 401ks, 403bs, 457 plans, you got to know that we got to dive in to get to know more about your money. This is numbers that came from the end of 2020, beginning of 2021. This was the average balance inside of a 401k. This was a CNBC article. They put this out. The shocking one, and again, who we're talking to tonight, that 50 to 69 group, that 50 to 69 group. Man, the average 401k balance for the 50 to 59s is 203,000. That's what it was back just a year ago, a little over a year ago. Ages 60 to 69, just a little bit higher, maybe almost 230,000. But put that into context, ladies and gentlemen. If you make $80,000 a year at the height of your career, if you make $100,000 a year at the height of your career, and you've only saved up $200,000, that means you've only saved up 2 years of your retirement, 2 years worth of retirement. Let's just say you're on the lower end, and at the height of your career, you made 50,000, 40,000. Well, even if that's your average, you only saved up 5 years, 6 years maybe of your retirement. So this is why, again, this conversation is important, ladies and gentlemen. I'm just giving you this information so you can understand that we really are in a retirement crisis. We really are in a retirement crisis. That's what you have got to know, okay? And because of that, we really got to be able to dive in and get some solutions and get some answers. And that's, again, what we're here to do. So here's something to know. Retirement, this came from an article also from CNBC last year that said retirement is looking less and less like a given, at least in the United States. It says overall, 59% of Americans say they accept that they will have to keep working longer. Imagine that, 60% of Americans, 6 out of every 10 Americans, 3 out of every 5 Americans say that they accept that they're going to have to work longer. That old 62 retire, 65 retire, probably not going to be it. It says 36% of people now believe they will never have enough money to be able to retire. That's pretty bleak. 36% of Americans believe that they're not going to have enough money to retire. Man, where's the hope? What can we do? What are the solutions? We can't go out this way, ladies and gentlemen. We can't go out this way. We got to make sure people are getting the information that they need because it's important. So here it is. These are the main factors that impact your retirement. Again, ladies and gentlemen, no taking time. Dive in, share this with a friend. Hit that thumbs up button, hit that like. This is going to put it in the algorithm. People need to hear this. You're 50 and older. That's specifically who we're talking to tonight. If you're 35 and you're listening, you're going to get great information. But it might not impact you just the same ways that it's impacting someone that's 61 or 58 or 55. But understand, if you have anyone that's listening or anyone you know right now, share this with them because this is going to help. These are the 4 factors impacting your retirement. These are the 4 main factors impacting your retirement. You got market risk. You got rising taxes. You got rising healthcare costs and health issues. And now we have inflation. Those are the 4 main factors that are going to impact your retirement, 50s and older. This is what we have to pay attention to. Market risk, rising taxes, rising healthcare costs, and inflation. Okay? So let's dive a little bit into each of these, give you some more education, get an understanding of what it is we're doing. Market risk. Most people have their money sitting somewhere in the U.S. stock, sitting in the stock market, right? To some degree, whether it's in index funds, whether it's in specific stocks, bonds, whether it's in mutual funds, doesn't matter. Money's invested in the market. What you see on the screen is a picture, a snapshot of what the S&P 500 has done over the past, 25 years up until last quarter, March of 2022. It's a real life look. So if you look at, 96 to 2000, we had some nice growth. And then what happened? We dropped off. The dot-com bubble. That was all that that time back in the early 2000s. Then we started growing again, went up another 100+%. 2008, 2007, 2008 happened, 2009. Here's where it's misleading, ladies and gentlemen, because since 2009, all the way until now, we've been on a steady run straight to the top. Obviously, we had that little bit of a dip in 2020, right at the beginning of the pandemic, where people started to freak out, but it was nothing. It was literally the shortest bear market in history because it only lasted for those couple months. And then it went right back up. So where we're at right now, look at this chart. If you are paying attention, whatever goes up must come down. We don't know how low it can go, but it's obvious that it will come down at some point. That's why you're hearing the recession talk, right? The depression talk, because we're now seeing the market slide. We don't know how low it can go. We don't know when it could recover. But you got to look at all the other factors and see what's happening and ask yourself, do you want to be risking your money in the market? Again, I'm talking to 50 and olders. 22 and you're listening, you might have time to risk your money in the market. You're going to get growth. If you believe in the model, the market should bounce back, right? Everything is, the US is strong, is going to grow over time. But if you're not, if you're 50 and older, 55, 57, you have to ask yourself, do you have the time to gain your money back? If we go on a 3-year depression or a 2-year recession, because that's typically what it is, just so you know, if you look back in history, right? Starts up here, kind of takes about 2 years to get to its bottom before it goes back to the top. Same thing, late 2006, early 2007, or late 2007-ish. It starts sliding again all the way down. 2008 really starts getting back up in 2009. So you might have a year, 2 years, potentially 3 years, depending on how low it goes. But can you wait that out? So right now, if you are in a 401k, 403b, stocks, bonds, mutual funds, any of those IRAs, retirement accounts, you got to ask yourself, what are you investing in? What are you putting your money into? Don't worry about if it's just safe, moderate, or aggressive. Like, where's your money at? Are you familiar with the companies that are dictating your retirement growth? Do you know where your retirement money is? We got to start looking at our money, ladies and gentlemen. Education is the key. If you've never looked at any of this type of stuff, this is the time to just start looking at it. We can help. That's why we're here. But understand, market risk is huge. So market risk is one of the major factors in your retirement, impacting your retirement. Here's the second one, rising taxes. Rising taxes. Please understand, ladies and gentlemen, that taxes will continue to go up. Taxes will continue to go up. Why? Why do you say that, Chris? Well, typically what happens, right? Like when our country is in debt, there's only really 2-3 ways that the country makes its money. One, it's by what it produces, what it imports and exports, right? GDP. Those things, that's how the country makes money. The other way, taxes. Taxes. How do you tax? Like, you have to be able to tax the workers, the people that live in your country. That's why we're talking about rising taxes, so more money can be funneled into the government so they can do more things, like hopefully fund Social Security, or hopefully be able to, right, strengthen some of the infrastructure things or things that are happening in our country. But at the end of the day, you have to understand, ladies and gentlemen, that taxes will go up. The government will want more of your money when they're in debt. It's the way it goes. So you have to know how your retirement gets taxed. How is your money getting taxed? You could be taxed now, you could be taxed later, you could be tax advantage. Okay, you got to just know where your bucket is. Where do you sit? Most people, because again, we're having the retirement conversation. Most retirement accounts fall under the tax later side, also known as tax deferred. That's your 401k, your IRA, those types of things. But then you have also tax advantaged. Tax advantage is the other side. There's a couple products in there: Roth IRAs, cash value life insurance, municipal bonds. Those things are tax advantaged. What do these things mean? This is how it works. If it's tax deferred, if your traditional 401k, 403b, IRA, tax deferred, then you have your Roth IRA, cash value life insurance, municipal bonds, tax advantaged. So from tax deferred, what happens? You pay no taxes on that money that goes inside of there. So you think of your check at your job, you got gross pay, they take out FICA, Social Security, all the other stuff, it leaves you with net pay. Well, from gross pay, money has gone into your 401k, 403b, 457 plan. That's what happens. So you pay no taxes on that money going in. However, when you're growing all of your retirement savings and now you're coming down to the end of the road and you're like, okay, now I got to start taking this money out. I want to think about what I'm doing for retirement. That money is 100% taxed. It's going to be taxed at your then tax rate, meaning whatever tax rate you're at when it's time to retire. All of the money inside of your 401k, IRA, 403b, 457 plan, TSP will be taxed. Didn't pay any taxes in, got to pay taxes coming out. Here's the other side. You could pay taxes going in, and then you pay no taxes on the way out. It really depends which way you want to do it. Some of you might already be all the way down the path where everything's tax deferred. Well, we just got to start planning for future tax things. But understand, you can choose to pay taxes on your seeds or pay taxes on your harvest. It's really up to you. But understand that's how that 401k, IRA, 457, 403b, TSP, that's how it works. It's tax deferred. Here's what you need to know about tax deferred. Something called the 59.5 rule. I've sat down with a lot of people that are in the process of retiring or getting a chance to retire. And it's always shocking to me about how many people might not truly understand this rule. We hear it, but we might not truly understand it. I've heard people get this mixed up. The 59.5 rule says that if you withdraw money from your tax deferred product, 401k, IRA, 403b, 457, TSP, if you actually go and try to pull that money out before the age of 59.5, this is what's going to happen. The government's going to hit you with a 10% penalty. Yes, the IRS hits you with a 10% penalty just for touching the money that's inside of there. Now, some people think this is where it stops. I've had conversations with people and I'll ask them, hey, how well do you understand this tax deferred product? Do you know what the 59.5 rule is? And they'll say, yeah, I can't touch the money till I'm 59.5 or 60 years old. If I touch it, I'll get penalized. But if I wait till after, I don't get penalized and I don't pay any taxes on it. I've heard people say that. And that's not the case. If you touch the money before the age of 59.5, you're going to get hit with a 10% penalty and you got to get taxed. Because remember, ladies and gentlemen, the money inside of there has never been taxed. So you know Uncle Sam's got to get his, right? Your favorite Uncle Sam. I don't think he's anyone's favorite uncle, but he might be somebody's. Either way, you're going to get hit with 28% federal tax. That varies depending on your tax bracket, depending on where you sit. That's a federal tax rate. 6% state tax, depending on the state that you live in. Some states have no taxes. Some states, like California, have a ton. But either way, you're going to get hit with those, and you're going to get hit with some fees coming out, some administration fees, right? Some transaction fees, those types of things. They got to liquidate your money out of the market. There might be a brokerage fee inside of there. They won't, say all of that stuff, but that's what's happening in there. So if you pull that money out before the age of 59.5, and this is comparable to kind of where you sit, well, 46% of your balance is going to go to the government. That's right, ladies and gentlemen. If you had $100,000 sitting inside of that 401k, that tax deferred account, and you chose to touch it before the age of 59.5, well, about 30, depending on the state you live in, depending on your federal tax bracket, but let's just say anywhere between, 35 to 45, 46% is going to go to the government. If you make it to age 60 and you don't touch the money, the only thing that goes away is the 10% penalty, ladies and gentlemen. The only thing that goes away is the 10% penalty. So you still are required for federal taxes, state taxes, and the fees that come out. So understand, if you did wait until age 60 to avoid the penalty, will taxes be higher or lower for you? Again, if you're already there, don't worry about it. We just got to make sure that we're not going to continue to get taxed more and more down the line. But if you're not, if you're at the earlier stage of this conversation, if you're 48, if you're 51, and you're going to go for the next 10, 12, 13 years to retire just to avoid that 10% penalty, what if, this is just a what if federal tax and state tax go up 5% over the next 10 years? What if they just happen to go up 5% each? Well, you're right back at where you were. Even if you got the 10% penalty knocked out and federal and state taxes happen to go up, you're right back to where we were, giving almost half of our money to the government. That's how tax deferred products work. There's also another rule in there called the 72.5 rule. Listen up for those of you that are in retirement right now. Some of you might be checking in, you might be in retirement, you might have just stepped into it, or you might have been there for a couple years. There's something called the 72.5 rule. Okay, the 72.5 rule says, let's say best case scenario, you do not need to use your retirement accounts. Let's say you are in a position where you've done some things right for yourself financially. You have other assets, other asset classes. You got real estate, you're lending money, you got, access to commodities or gold or oil. You're doing all these other things. And this 401k or IRA or 403b or 457 plan, you actually don't need to touch it. You actually don't want to. You just let it sit there and do what it's going to do. Well, your favorite Uncle Sam put in something called the 72.5 rule, which says that if you choose not to touch that money, they're going to do something. Well, at 72.5, they're going to make sure that you actually start to pull money out of that account. It's called RMDs, required minimum disbursements or required minimum distribution. It's a forcible withdrawal out of your tax deferred account. So the government's going to say, hey, you've never paid us any tax dollars on this stuff. So now that you're age 72.5, you're going to get a letter that says, now you got to start taking money out of this account. Normally it's around 1%, 1.5%. It goes up every year. Right? If you have a letter, it scares a lot of people if you don't know that that's coming. But basically, it's just telling you got to take some money out so we can get our tax dollars. If you chose to not do that, there is a 50% penalty that they tack on. If you chose to not take the money out, I'm going to hit you with a 50% penalty. It's literally the rule written in says if you don't use it, you'll lose it. That's the 72.5 rule. Those are two things you got to know about these tax deferred products, the 59.5 and the 72.5 rule. Understanding on both sides why that's important. So again, market risk, rising taxes are going to all impact your retirement. Here's the other thing that's going to impact your retirement, ladies and gentlemen, rising healthcare costs and health issues. Rising healthcare costs and health issues. We are seeing healthcare costs continue to go up. Here's the thing. We're seeing health issues continue to go up. 1 out of every 3 people, they say you'll get cancer. Everything is heightening, right? We're seeing all these sicknesses and illnesses and things. Here's the long-term care, a quick study that said by 2030, 24 million Americans will need long-term care. Imagine that by 2030, guys, we're not far away. 7, 8 years. 24 million Americans will need long-term care. Long-term care means you can't do 2 of the 6 basic daily functions. You can't bathe yourself, walk, eat, clean yourself. There's like 6 of them. But that's what people need long-term care for. It says an estimated $849 billion worth of long-term care was provided in 2018. It says this study estimates that in 2030, long-term care costs will be more than double and may reach as high as 2.5 trillion. Imagine, ladies and gentlemen, you hit retirement. You are cruising in retirement. Things look good with your pension. Things look good with your 401k or your retirement savings. You're doing some things, you're traveling, then boom, you hit 69, you hit 71, you hit 74, and you get sick. Something happens. You need some long-term care. You need somebody to come in and take care of you. You need an assisted living facility. You need someone to stay with you. You need a home health aid care. You need a nursing home. You need someone to take care of you. Your children might not be able to do it. They might not have the means to do it. You might not have the living space to do it. So then what do you do? What do we do? That's why this is important for us to pay attention to, not just the money that is in the market, but the upcoming things that are going to happen in retirement that we need to plan for. Shows here 2020 annual long-term care cost. It breaks it down: assisted living facility, homemaker, home health aid, and nursing home care. I want you to see that for an assisted living facility, average annual cost across the United States is about $51,000 a year going towards assisted living facilities. Ladies and gentlemen, if you had a Social Security benefit of $2,000 a month, which is $24,000 a year, you would not be able to afford your own assisted living facility. You would not be able to afford any of the things you need for the healthcare, the rising healthcare costs. Jump all the way to this other side where it says nursing home care, $105,000 a year annual costs across the United States. In California specifically, it's about $126,000. I don't know where you guys are checking in from, but if you're in California, you should really be paying attention, extra attention. Are you prepared? Are we prepared for these things, ladies and gentlemen? Here's another couple things I'll pop into for long-term care. Again, this is something that the government is going to have to pick up, because if we don't do it for ourselves, well, the government's going to have to try to step in and help us with health care. So it actually says here, right, that Medicaid's inflation-adjusted expenditures on long-term care services will increase from $130 billion in 2020 to $179 billion in 2030. That means that the Medicaid costs are going to go up. I just told you that the government's $28 trillion in debt. Where are we getting this extra $40-50 billion to continue to move forward in this long-term care healthcare side of things? Or will there have to be another way? I want you all, everyone that's listening to this, that took the time to jump on and hear about their retirement and dive a little bit deeper and take some notes. I want you to be prepared for this by having your own, to not depend on what Medicaid's going to do or what someone's going to come in and do, because they don't have it. So you got to make sure that you're taking care of yourself and your family and the things that are coming up. This is a similar chart to what we just saw, but I just want to bring this in context. I don't know where you're checking in from, but this is a median monthly cost of a private room in a nursing home from Business Insider. If you can see that on the screen, I'm here in Pennsylvania. Pennsylvania says the average cost of a room in a nursing home is $10,000 a month. Are you kidding me? $10,000 a month? And we're supposed to retire on Social Security, a pension, and our personal savings? I don't know how people are thinking they're going to do it, but we got to start to really dive into our money right now and get very, very good at learning how to plan for what's up ahead. Last one, after market risk, after rising taxes, after rising healthcare costs and health issues, you got good old inflation. Listen, there's not much we can do with inflation, to be honest. There's not much we can do. But it says here, this is a very recent article within the past 3 weeks, that 25% of Americans are delaying retirement due to inflation. Literally, a quarter of Americans that are thinking about retirement are thinking about delaying it. You're going to retire at 67, maybe you do it at 70. You're going to retire at 62, maybe you do it at 65. They're delaying their retirement specifically because of inflation. By the way, you're probably feeling this inflation right now. Cost of goods will continue to go up. The power of your dollar continue to go down. That, not a good mix. We got a plan for what's up ahead, ladies and gentlemen. So, real quick, I just want people to understand that are paying attention and watching that this is what we're talking about. This is the most important thing for those of you that are thinking about retirement. This is going to be the most important stuff for you to pay attention to. I told you guys at the end of this, we're going to have a live Q&A in Zoom. If you see it on the bottom of your screen there, there's a bit.ly link. If you already know you have some questions, you already know there's probably some things that you're going to want to go over or you're going to want to ask personally, jot down that bit.ly link. As soon as we get off of this in the next 15 to 20 minutes, as soon as we jump off, we're going to go inside of that Zoom and you have the ability to interact with me one-on-one and actually get your questions answered if need be. It's bit.ly/UA retire. That's what that link is bit.ly/UA retire. That's happening right at the end of this. I know I've been giving you a bunch of information. Hopefully you've been taking some notes, but if you have a couple questions, specific questions, we're going to be able to jump in right after and make sure that you can get them answered. Okay. So stay tuned. We're coming to the end of this. I just want your mind to be in the place to understand if you need the help, this is the time to get it. This is the time to get it, ladies and gentlemen. So let's dive in. What are the solutions? You're like, Chris, you told me all the problems. I'm depressed now. Like, why am I listening to you? No, I'm not trying to make you depressed, ladies and gentlemen. I'm trying to let you know that this is real and that we have to focus on these things. When it comes to your money, you have to inspect what you expect. So if you expect to retire, then I need you to inspect your retirement. If you expect to be comfortable after you leave work, then I need you to inspect how comfortable you are with your money right now. So you got to inspect what you expect. So the solutions, by the way, the solutions vary by age. I'm going to make a couple ballpark kind of things here, kind of generalizations, but understand everyone's financial life is a little bit different. Everyone's financial life is a little bit different. I told you all that tonight was specifically for like the 50 and olders. So again, if you're listening in, you're 25, you're 32, you're 28, or whatever the case is, this might not be all the things for you. But again, anyone over those ages of 50, like this should hit home. So here are the solutions. By the way, before we dive into that, what are the phases of retirement? Write this down if you don't know it, ladies and gentlemen. 3 phases to retirement. You have the contribution phase, you have the accumulation phase, and then you have the distribution phase. The contribution phase is when you are contributing to that plan. You know exactly what you're putting in. You know what the plan is. You're doing it. Accumulation is now you got to get that money to grow. You got to be a little bit more aggressive. You got to get into the right funds. You got to make sure that's accumulating for you. Most people now are headed into distribution. That's how do I get my money out? How do I distribute it to myself? I've worked for it all these years. How do I take it? How do I get it? Here's some solutions for you. Broad range, age 46 to 55, it's game time. 46 to 55, it's game time. You need to have detailed planning. If you've never worked with a financial professional, a planner, a coach, an advisor, anybody like that on a consistent basis, now is the time. You need to have some detailed planning. Take it serious. If retiring is serious to you, take it seriously. Take it seriously. Spend some time. What does it mean to take it seriously? We give time to the things that we prioritize. We give time to the things that we value. So if your money is serious, give it time. Sit down an hour a day, an hour a week, 2 hours out of every other week, and look at your money. Get organized. Put a strategy in place that will ensure you hit your goals in retirement. It's time to strategize. You got to begin calculating your net worth. What are you worth? Got to have a heavy focus, though, around asset accumulation. How are you accumulating, right? You're there, but now you got to keep accumulating. For some of you in the 46 to 55, if you did it properly, you should have some money to be investing in these assets that are going down. This is the time to pick up that rental property. This would, not now, but like maybe in the near future, right? As this thing continues to drop, it might be the time to pick up that rental property. It might be the time to invest in that business if you've done it the right way. Your money might not be best suited sitting in the stock market and stocks and bonds and mutual funds with the market doing what it's going to do, because I just showed you what it's doing. Maybe it's time to grab some hard assets, some real assets, some things that are tangible. Maybe it's time to get some gold. Maybe it's time to get some real estate. Maybe it's time to get some more, some businesses, or invest in a startup. I'm not sure, but I'll tell you, you got to get organized right now. The 56 to 70, retirement red zone, fourth quarter of the game. I put this statement in there because I heard this a long time ago from a retirement professional, and it just stuck with me. Landing the plane is the most crucial step. Landing the plane is the most crucial step. You've been flying for years. You're good. You've been in the air. You figured out how to do it. Landing the plane is the most crucial step. It could all burn down if you don't land the plane properly. So coming out of the accumulation phase into the distribution phase, you need planning. You're coming out of accumulation into distribution. If you are not working with anyone to help you through this process, you need to reach out, because this needs planning. You got to look at all the picture. You got to look at all the things, not just what's happening in the stock market. You got to look at your whole retirement picture. Right now, you need to make sure you are protecting your money, avoiding high taxation, and not outliving that money. 56 to 70, retirement red zone. Could even be 60 to 70. I don't know, but 56. Some people want to retire at 58, 59. If you got less than 5 years, red zone. Landing the plane is crucial, guys. That's what we got to do. So think of these things that impact your retirement: market risks, rising taxes, rising healthcare costs, health issues, and inflation. Ladies and gentlemen, we can't do anything about inflation. We have no control over inflation. Zero. It's just something that happened during this time period. For people that retired in 2013, right? Inflation wasn't a big deal for them. For those of us that are heading into it, it's going to be a big deal for you. But you got to control what you can to limit the impact of those other ones. You got to control what you can. Don't just give up and throw your hands up and say, it's not worth it. I don't know what to do, right? You got to control what you can. So here's how we control these three. One, you got to learn to secure your money from the market volatility. You got to secure your money from the market volatility. Two, you got to limit your future tax exposure. If all of your money is in that retirement account, that 401k, IRA, 403b, 457 plan, something like that, you got to limit your future tax exposure then. Because you can't get away from the taxes already because you haven't paid any on that money. But the future tax exposure, you got to be able to limit. Lastly, look into long-term care policies. This is something I'll touch on if you jump into the Q&A right after. Again, right after we're done, we're going to go into a Q&A on Zoom. If the person that invited you, if you didn't see that last link or you didn't copy it down, text the person that invited you to this, right, to this webinar, and they may have that link. But you got to look into some long-term care policies. We just looked at what's going to happen. How's your long-term care? What if you need hospice care, in-home nurse, nursing facility down the line? Do you have something in place, or is that going to come out of your retirement? Or is that going to be something your children pay for? That's what we got to look at. Side note on that, work on improving your health, ladies and gentlemen. You know how you can avoid staying in some of those places? Work on your health, your mental health, your emotional health, your spiritual health, your physical health. Exercise, watch what you eat. Watch what you're listening to and taking in. Yes, stress can lead to sickness. Worry can lead to sickness. So if you listen to the news a bunch and you're getting a bunch of stress hormones, right, like flowing through your body, that could lead to decreased health. So work on improving your health while you're at it. But those three things: secure your money, limit your money or limit it from future tax exposure, look into long-term care policies, work on your health. Here's a couple things I'm going to leave you with. How your money grows. How your money grows. This is what we show you. Your money is going to grow fixed, variable, or indexed. Fixed is one rate all the way out. It's very safe. You might have a fixed rate on something and you might be okay, but you're not going to gain a lot of money. You got a fixed rate CD in the bank, you're not going to gain a lot. Then we got variable. Up and down with the market. That's where most people's money is. $6.1 trillion is in the US stock market and 401ks and tax deferred products. Then we have index strategies. Gives you the best of both worlds. Here's how it works. Those fixed products, normally you're going to get back 0.25, 1%, 2%. Your principal is safe. You're not going to lose anything. But inflation's at 6%. So if you're not outpacing inflation, it's going to be really tough for you to be able to grow anything. That's what fixed products are. But then you got variable products on the other side of that give you great upside potential, right? You can make a bunch of money inside of those products. But you could also lose a bunch, which is what we're seeing right now. So the question is, what can give you both? That's what the index strategy does. Index products and index strategies give both the upside potential and the safety of principal. That's what happens inside of an index strategy. Now, why haven't people heard of these index strategies? That's what people always ask me. Why haven't I heard of it? Why didn't my financial advisor tell me about it? How come I don't know about this? Well, typically it's because the people that sell us our financial products, they make money from putting our money into the stock market. Your typical advisor gets paid assets under management or fee-based in order to put you into the right products. They get bonused by their company to make sure that they have that, that they're continuing to put more assets under management. If your job is the only, place that you get any type of financial advice, right? The rep from your 401k, 403b company is the one that shows up every month or every other week, and you have the ability to sit down with them and talk to them about their 401k or 403b, well, their incentive is to keep you in the product. They work for the company that sold you the product. They work for the company that is incentivized to make sure you have it. So of course, when you get the information from the people inside of the company, they're going to be like, oh, everything's great. Oh, stick it out. Oh, hold on to it. Oh, you're going to have a bunch. They're going to always tell you that because they sold you the product. But index products, index strategies, they typically are attached to insurance products. And so what we don't know a lot of times in the financial, right, like when we don't dive into the financial space, is that, banks are backed by insurance companies. So where we go and put our money in the bank, or we get a CD or whatever the case, they go and loan that money out. But they also reinvest back into insurance companies because the insurance companies give them the best return. So what we do is say, well, let's take you away from the bank, from the middleman, from that person, and go straight to the people that are going to give you the best return. How that index strategy works. This is an old clip, but if you took that 100,000 invested in 1997, right? This is for 15 years in the market. that's how the market would have kind of played out. You would have gained some money, you would have dropped, you would have gained, you would have dropped, just like variable. At the end of that 15-year period, you'd have about $150,000. But if you had an index strategy where you had a floor and you had a cap, meaning you couldn't go below a certain amount, and you didn't get all the full gains of the market, you only got the partial gains, but still you never lost money. This is how it would turn out. This is at a 15% cap and a 0% floor. So look, over that same time period, that's a $62,000, $61,000 difference just by being invested in a strategy that actually works, that your money's not invested in the market, it's just mirroring the market. So what I say, insurance companies have these types of products. Transamerica has a great product called an IUL. It stands for an indexed universal life. So think about it, all you 46 to 50-year-olds. You say, hey, Chris, you sold me. I don't necessarily need to be tax deferred anymore. I don't need to be in that 401k, but where else do I go? How do I go tax advantaged? Well, we got Roth IRAs and then we got cash value insurance. This is a type of product that's out there. But if you can see what I just explained to you, there's a guaranteed minimum, a floor, and a cap. So 0.75% is the floor. If the market drops below that, the market does -20, you're going to get 0.75%. You're going to gain. In a good market, you're going to make 15%. Now, in this example, if the market gives back 28%, you're only going to get 15, but you're guaranteed to never take a loss. The thing I'll highlight for you on the screen is the 20-year look back. From 2001 to 2021, if you were just inside of the market, you'd have gotten back about 5% over that 20-year. About 5% on the index, right? The global index. But if you had the floor and had the cap, if you had a floor of 0.75 and a cap of 15%, you would have gotten back 8.92% in that same period of time. 8.9%. So over time, policies like this allow you to make sure you don't lose money and you can still get the gains of the market and protect your assets in a down market. The other one is called a fixed indexed annuity. A fixed indexed annuity. Also another insurance product. It says here, this is from, I think it was from Barron's or Kiplinger. I'm not sure what this article was, but it says annuities, they may be a better option than you think. This one says how to protect your retirement with income annuities. Here's a Forbes article that says 5 ways fixed indexed annuities are the Swiss Army knife of retirement planning. This was from Forbes. It said, this was 2020. It said, as a licensed fiduciary for over 15 years and spending most of the time with retirees, I've heard the same desires and concerns repeatedly. They want a retirement product that will offer them safety, income, and growth. My clients' fear of a repeat of 2000 or 2008 are concerned with how to pay for long-term care and are very concerned about outliving their retirement assets. When I hear this, there's one financial product that comes to mind that can help address all of these concerns. A hybrid annuity, also known as a fixed indexed annuity. I know you probably haven't heard of it. It's okay. It just means that you haven't gotten around the right people to get you the information. But again, that's what we're here to do. Here's a video I'm going to share with you guys if and when you jump into our, where is it? Yeah, when we jump into our next Zoom, if you jump in there, our private Zoom, bit.ly/UA retirement, I'm going to show you that video about what are annuities. It's a 3-minute video. It's not that long, but it's going to give you a good overview and a good understanding of what annuities are. That's in our Zoom right after. Whenever you're ready to dive in. But that being said, my fault. Cool. Some basic ideas about that indexed annuity, some things to know. I'm just going to highlight 2 of them. Market volatility on your side. On the indexed annuity side, you never lose principal. Big one, if you start pulling money out of your 401k, 403b, 457 IRA, you're going to deplete that money. However, if you have an indexed annuity, you will get a stream of income for life. I'm going to share with you guys more of that stuff if you have questions, but just remember, we're here to help. We're here to help. People don't plan to fail. We just, right? People, they just fail to plan. They just fail to plan. Getting to retirement requires a plan. If you are listening to me and you are in that age range that you are thinking about retirement, it will require a plan. So now that you've been introduced to some of the information that we have, just understand, here's what we do. United Agency, my wife and I, our brokerage, we are a subsidiary, right, and a conglomerate with World Financial Group, Transamerica, and Aegon. They give us the strength and credibility in the market to be able to help people with products and services in the insurance world. We're non-captive, so we don't have a stake in anything we offer. However, we always get the best product for the people that we're sitting in front of. The thing that we come to do is really put a full financial plan in place for people. Tonight, we only talked about number 5, which is building wealth. It's the retirement piece. That's all we really talked about. But understand, there's so much more that comes into play in your financial life. If you're about to head into a fixed income, if you're about to get to a place where you have the same amount of income coming in, then you need to know things about your cash flow. How much is going out? What are your monthly expenses? Have you sat down and looked at those things? Are there any things that are going to cut out? Are there any things that we need to add in retirement that will affect our cash flow? It's important to look at. The second thing is the emergency fund. If all you have is retirement savings, then what about the miscellaneous savings? What about when the heater breaks in your house? What about when you want to take the vacation? What about when the car breaks down? Do you have emergency fund money set aside outside of retirement, specifically 3 to 6 months worth? If not, we have to help plan on how to get there. Debt management. How's your debt? If you are headed into retirement, into a fixed income type of place, you got to make sure we're not paying any high interest debt. Your goal is to now earn interest, not pay interest. The fourth is proper protection. That's all of your insurances. We did touch a little bit on long-term care insurance. You should look into it. We can help with it also. It's something we do. But you should look into long-term care insurance. How are we protecting your health? Not to mention, it's probably time to revisit your life insurance, ladies and gentlemen. I just sat down with a young lady earlier today. She's not young, she's in her 60s, but still just being polite, right? Young lady today. And we talked about her retirement. We were talking about her annuity. We showed her the annuity. She was like, oh, that's great. Let's go do that. Then I asked the question. I said, hey, what about your retirement? She's like, or what about your life insurance? And she said, I don't really know. I talked with the rep a while back. I think I have a permanent policy. It might be term. I'm not sure. I told her to pull it out and let's take a look at it. And she looked at it, and we found out that probably sometime within the next, I think it was 7 or 8 years, that premium was going to jump up. She was going to go from $300 a year to $3,000 a year. And she wouldn't have known. She might not have been able to do it. And so she would have had to cancel that retirement or cancel that life insurance in the midst of her retirement. Well, that's not what we're trying to do. We're trying to make it all the way out. So you got to start reviewing these types of things. We can do that for you. The building wealth part, that's what we talked about tonight. That's 401ks, IRAs. Time to dive in. Go get a statement. Go look at exactly what's been happening to your money. Lastly, do you have an estate plan? Do you know how to pass it down? Do you have a will? Do you have a trust? Do you understand what those products are used for? If you own a home, if you have any asset and you have a will, do you know that that does not avoid the probate process? Probate, when you pass away and you're trying to pass things down to the next of kin, it doesn't just go and transfer to them. It'll get seized by the state, by the government, and then your family has to go back and get it back from them in the probate process. If you have a will, that's great. The judge will read off the will and say, oh, right, the house belongs to them. That's fine. But you had to go through the courts to get it. Well, if you had a trust avoids the probate process. But a lot of times we're not educated on it. We can help with that. That's what we come in and do, is look at all of those 6 things. Retirement is big, but you got to look at your entire financial picture. And the best part is we do this stuff for free. We do this complimentary, just like you've been on here for this past hour listening to me talk about retirement. That's exactly what we do when we sit down with you one-on-one. We sit down and we talk with you and you strategize and we help you put a plan in place. We help you look at these products like indexed annuities and index universal life products. And we make sure that you have savings, make sure you have a will and a trust, and we do it all complimentary. We found out there's 2 reasons typically people don't work with a financial professional. One, they don't know who to trust. They just don't know who to trust. They don't know who to go to. That's why we take our financial information from our parents and our peers and the coworkers and the people around. It's just because we don't know who to trust. They might not even be giving us the best advice, but at least we trust them. At least we know that, like, we know them. So if they're doing it and they mess up, then whatever, I mess up too. So we got to have someone to trust. The second reason, they just don't want to pay someone. You know, Morgan Stanley, Charles Schwab, Merrill Lynch, if you're in that league and that's who you're sitting down with as an advisor, they're charging you for all these things. Your typical financial advisor is going to be fee-based to some degree. So you're going to pay for all of this information. You're going to pay for that plan. You're going to pay for them to help you through the process. But we know who we come to serve. It's the people like you that are jumping on this call, that are on this webinar, that are sharing it with people that they know. You're the people that we want to come help, so we can do it complimentary for you. All you got to do is set up some time with us. All you got to do is set up some time, guys. We appreciate you joining. Understand, right now we're about to go into the Zoom session. If you have a question or anything we can answer for you, we're going to spend about 30 minutes, 45 minutes over there. Jump right in. If you have the link, dive in. But that's where we're going to go to answer these questions that you might have. We appreciate you joining and listening. Share this, like this, get this into the hands or the feed of somebody that is about to retire or thinking about retiring. That is going to bless their life. It's going to help them. Just one thing that I said, one thing that sparks a question, one thing about long-term care, one thing about an index strategy could change their entire retirement picture. But we got to get the information to people. That's what we come to do. Just so you know, my wife and I represent United Agency. We have a vision for helping families, building people to get to a better life. That's really what it's about, helping families understand money, protect their money, really do all the right things. We want to build people into the people that God has called them to be, the man or woman that they're called to be, and then know that there's hope for a better life. Where you are right now, you can have way more. And we're looking to do a lot of things over the next 4 or 5 years, guys. We're looking to make 1,000 families become financially independent through entrepreneurship. We know that having a job right now might not be the easiest thing. It might not be the thing that's bringing you all the income that you need. And we want people to know that you can be financially free and financially independent with your own skill set, with your own talent, with your own hobby, with your own gifts. You can be financially free. We want to lead 1 million people on a journey of self-mastery and personal growth to achieve the highest, grandest vision of their life. We believe that you're destined to become greater and that you have more in you. So we want to help guide you through that path. We're going to help 1,000 families make 100 grand a year through the platform of World Financial Group. It's amazing. We've helped tons and tons of families across North America have an additional stream of income, build extra money for themselves. Our job is to then also sow $10 million into small businesses to help entrepreneurship around the world. We believe how important this is to give people an opportunity to create something for themselves. And then we want to be able to create a dream, a vision school for all the youth to be able to start dreaming at an early age. It's important. It's important for our future. It's important for what we're building here to make sure that people have a vision for what their life could be. That is what we do here at United Agency, ladies and gentlemen. That is why we sit down and do all of this with you or share this stuff with you. It's to make sure that you can get access to a financial professional. Oh, did it go off? There we go. Access to a financial professional, access to somebody that can help you get to where you got to go financially. So again, my name's Chris. If you guys are hearing this or watching this and it's on the delay or it's afterwards, feel free to message me. Feel free to reach out. I'm at CMuzon1 everywhere, Instagram, Facebook, LinkedIn, TikTok, doesn't matter. Hit me up, ask me a question. setup time, more than happy to dive in with you. But for everyone else that is watching this live, let's go ahead. Let's dive into our Zoom. Let's dive into our Zoom and let's get the rest of the party started. Ladies and gentlemen, I appreciate your attention. Enjoy the rest of your evening.